Welcome back to the Behind the Well Show. I'm your host, Roger Abel, here with Elias, Randel, heading into the end of the year. Eli, I feel like we need to do a show about the themes of 2022 and what was popular and what the major headlines are. And I know Molly has that planned for the next show or two to kind of summarize the year, because it's been a fairly interesting year, I think, to say the least. We've seen some interesting moves in the market. In fact, I was listening to CNBC on my way home for lunch today, and I'm going to quiz you. Do you know what the 10-year Treasury was entering the year of 2022?
No, I don't.
It was around 1.8%, I think. It traded 3.56 today. That's a huge move. Yeah. It's double the increase in interest rates. So a lot of really, really big things has happened. And, I'm getting the question, and I'm sure you are too. What's going to happen next year? What's the 2023 outlook? And what does your little crystal ball say? And we always have the answer. We don't have one. But I'm gonna hit you up and just say, hey, what's your 2023 outlook? What do you think the themes are going forward next year? What are your thoughts and feelings on the market?
Well, okay, so for clients, I think more of the same is probably a good message. More volatility, more uncertainty. We just have, until we're out of the clear of inflation being too high and recession, the odds of recession being too high, I just think there can continue to be a lot of negative sentiment from investors. But ultimately, and we talked a little bit about this on our radio show, typically the market will turn around before the economy does. So people should wait until things are good as far as like the overall economy. But I think right now the best mentality to have is, I've already decided I'm going to get through this. I'm going to continue doing that. And, it's just, you can have like one bad year or two bad years in the last 12, and it shouldn't be detrimental to your overall goals.
So there's a recent study by CNBC. They surveyed, it's called the CNBC Millionaire Survey. So they surveyed millionaires. Millionaires haven't been this bearish since 2008. 56% of millionaire investors expect the S&P 500 to decline by double digits next year, of at least 10%. A third of them expect it to decline by more than 15%. I think that's overly bearish. If you look at the past economic cycles of how many back-to-back negative years we've had in the markets, there's been very few back-to-back negative years. And right now we're looking at a minus 20 this year. And a third of the people believe it's going to be minus 15. And what comes to my mind when I hear that is that people are very fearful right now. And I think the talk of we probably are going to have a recession at some point next year. Really, is it kind of a mild, moderate, or deep recession? Kind of rings true to what you were saying. Like, we don't know what's going to happen, but I just find it hard to believe that people believe over a 2-year period of time we're going to be down 40%.
Yeah, that's hard to believe. I don't know if I can get with that. I guess I'm not surprised people are that bearish. I think that's probably, I would say for the last year, I've probably been more bearish than I have for a long time. But I actually think where we're at now, I don't think it should be too surprising or too shocking. Just with like earnings and where the S&P is actually priced. We're actually priced in probably what's considered to be fair value as far as like the multiple and all that. So, and it could get worse, but I don't know. But then the other part of me is like, well, if that many people are really bearish, typically the majority's wrong trying to predict things like this. So we'll see what happens. I know the people that have good investor behavior and own a good, like a quality portfolio where they're diversified and they've done the prudent things as far as planning, I'm very confident all those people will be fine. And and probably won't have too many. It might be another year with some hurdles, but probably not too many stumbling blocks as they go.
So I just pulled up a quick chart of the S&P returns year by year to go back and see how many back-to-back negative years the market's had. Okay, the last time we had back-to-back negative market was 2000. The market was actually negative for 2000, 2001, and 2002. So that was tech bubble and 9/11. The cumulative down market there is 46%. So it's been 20 years since we've seen back-to-back negative years in the stock market. Before that, the last time we had a negative back-to-back stock market year was 1973 and 1974. So in the last 50 years, we've had 2 times we've had negative back-to-back stock market. So I don't think I'm just going back to that millionaire survey, and I'm not sure that I would read too much into how people are feeling because we don't really know what's going to happen with the stock market. I do believe, I'm with you though, we should just expect an increased level of volatility for the time being as we kind of try to figure out what's going to happen with interest rates. That's what a lot of this is where are interest rates headed? Are they going to keep going up? Is inflation easing? We had the Fed meeting last week and, what the Fed said didn't necessarily line up with the economic data. And what I mean by that is we had two relatively good inflation reports, better than expected. But then Jerome Powell came out and said, hey, we're going to be higher for longer. So it was almost like mixed messages to the investing community. And a lot of people are starting to believe that Jerome Powell's looking more at actual employment than just inflation.
Which would make sense, right?
Well, I mean, as long as have a high, or a low unemployment rate and wages are going up, it's going to be very difficult to really rein in inflation. People just spend more money. But when people start to lose their jobs, which we're seeing, if you look around, I just read an article about out in San Francisco, the Salesforce building, it's like half empty.
The company Salesforce?
Not the company Salesforce, but their tower, because what's happened? Meta's laid off 11,000 people. Companies have stopped hiring. They've sent workers home since COVID. Like, there's not as many people going to the office. But if you look who's laying people off right now, it's in the tech space, which has been the hardest hit by rising interest rates. At some point, that's probably going to start to trickle down through the economy. And that's really what the Fed wants. I think they had a target of unemployment of about 4.6%. We're at 3.7 today. So that's a 25% increase almost in unemployment.
Right, and I guess all the messaging has been they're going to do what it takes to hit those metrics. So,
yeah, I would expect things in the economy to get tougher. Doesn't mean, though, like you said, the stock market necessarily will follow. It's a forward-looking indicator. There's a chart, we can put it up on the website, btwellshow.com, that just shows, market typically recovers 6 months before the recession ends. So the question is, when do we enter the recession and when does the stock market, begin to recover? And none of us know that. We obviously don't know that. But those are the things to think about. Just because somebody says, hey, there's going to be a recession doesn't mean that the stock market's going down exponentially further. It doesn't mean it won't go down. Just doesn't mean it means that the end may be in sight sooner rather than later.
Well, and we very well could have already seen the low prices. I mean, we could have already hit the point that we're not going to go lower than that. No one knows.
Yeah, nobody knows. I mean, we're getting close to retesting the lows, though.
Yeah.
We're off. We had the rally in October, November, and we've sold off pretty rapidly. I think people are starting to get the all clear signal in October and November when things are pretty good. In fact, I had a client I ran into the other day. She's like, man, I was so happy to see my account went up for the month of November. I said, yeah, it feels good, doesn't it? Hopefully she doesn't see what happens in December. It's going down again. But one thing that happened the other night, I know we were at the client event, and someone asked you, Elias, in one sentence to sum up what you think the stock market will do next year. What was your answer? I thought this was great.
Yeah, okay. Well, the question was about what's in one sentence, how do you think people should be investing for the future? And I think some of the things we're going to talk about today highlight that, but I think my answer, I didn't give a sentence. My answer was quality. I think you should own, right now you want to own companies that have been around for a long time, have good cash flow, have always paid a dividend. They don't miss dividend payments. Maybe they raise their dividend. And I think if you think about where we're at, so like what led the way for the last decade, technology companies, were all of them making money? No, but they had apparently in the public markets, they were worth a lot of money even though they weren't making any money. And that was possible. You could value those companies that way in a low or zero interest rate environment. But we're getting back to, I feel like we're getting back to an environment where a lot of the other metrics other than just like speculation are going to matter a lot more. Like paying a dividend, what your cash flow actually is, and just all those more traditional metrics. And I think if you own, I guess I at least find some, if you own companies that have survived other recessions, I think you can feel like they're going to survive again. Where if your whole portfolio is technology today, well, there's probably a lot of those that may not survive this recession. They may not be able to get the funding they need.
So I'm going to ask you a question. I'm not sure you'll remember the answer.
Okay.
The summer of 2021, what was the theme of the best investment?
The theme of the best investment in 2021?
What were the best investments in 2021?
Technology investments?
No, we joked about it. Just go find the dumbest, stupidest thing out there and buy it. It's going to go up in value.
That's back when we were going long on stupidity.
We're going long on stupidity. So think about where we've come from. We went from, hey, buy anything that doesn't make any sense and it goes up, to you better be buying quality companies that have dividends, share buyback. So it's funny how investing themes change because, 10 years ago we talk about dividends and rising dividends and why they were important, and all that kind of went to the wayside when value just drastically lagged growth for 3, 4, 5 years. No one to own it. And now we just kind of come back to, hey, go pick the boring investment that pays a decent dividend and let it do what it's going to do. But we all got greedy. Everybody got greedy. Doesn't matter who it is. Everybody wants a piece of it when it's really, really good.
And the other thing I've been thinking about recently, it's a Warren Buffett quote, but the one where he talks about when the tide goes out, you see who's swimming naked. And he's talking about like portfolios and not being positioned
We're
correctly.
already seeing it. FTX gone.
Right.
Hey, you can get away. Hey, when prices go up, when Bitcoin's at 66,000, you can pull off whatever scheme you want. Prices collapse, then there's problems. This happened in 08, 09.
Well, and it was also, so in 2021, to go along with what you're saying, it was just buy the most speculative asset and it goes up. And I feel like we're entering into another cycle where professional investors, and like it was also cool to talk about how Warren Buffett's too old for investing back in 2021, right? That was another thing that was cool to do. Well, he's just out of touch. He's too old. And now it's like the tide is turning, and who's going to be standing there having the last laugh once again in another decade? Meanwhile, that's what
he's letting everybody bash him. He's too old. He doesn't know what he's doing. It brings up another thing is I'm just reflecting back over the year, and I know I'm kind of skipping a little bit forward. I haven't seen a TikTok video on how to invest in options or make $1,000 a day or $10,000 a day trading for a long time.
Or remember the most crazy one we talked about? Take $100 and turn it into $1 million.
That was the exact one I was trying to think about. I wish those guys would do a video how I lost all my money trading, because that's what's happened.
Oh yeah, I'm sure it's devastating. Some of the stories and losses you could hear.
It's
about
really
now.
easy to make money when everything goes up. What are you going to do when it goes down? Because the people who are making excess profits, or you heard about the guy who made so much money in one investment, they had to take a level of two things. One of two things happened. They either got extremely lucky, or they had to take a level of excess risk to get it. Because most people aren't throwing around enough money to turn it into a meaningful investment that would change their life.
Well, they're finding out now, but yeah, there's a lot less TikToks. There's a lot less videos, and this is my own personal experience. There's far less people asking questions about meme stocks, cryptocurrency, all the things that were super popular a year ago at this time.
But one of the things I think that will matter more is dividends, yield, interest rate, kind of making up more of someone's total return portfolio. So, we've talked about having a fair rate of return. What's your rate of return goal? If you go to our website, you can download the retirement survival guide. I'll have Molly put that up there, but talks about some of the core values and why you should have a fair rate of return goal. Is your goal 7%? Well, if your goal is 7%, the last 10 years, you've pretty much had to be mostly growth, because not that many things are paying much more than 2 or 3% tops in interest, unless you're really stretching for yield and you're taking on more risk. But all of a sudden today, we're looking at 12-month CDs that are paying in the mid 4s. So if your goal is 7% and you're getting 4.5% from some fixed rate investment, you only need 2.5% of growth. It's going to make it much, much, much easier for the average investor to hit that, total return goal that they have based upon where interest rates are today.
It will be. And for more, certainly older investors who are typically more conservative, that's probably a good thing, because people maybe had to kind of extend their risk tolerance a little bit to get the returns they wanted. Especially, it's hard to buy, when a CD, we'll call it 2 years ago. Well, the market's going up like crazy, and what's the best CD available out there a couple years ago? Less than 2%, probably, maybe not even that.
Buy them at 1.5. It was crazy.
So people were willing to take on a little bit more risk, and I guess hopefully that ends up being maybe a silver lining of this current environment, is maybe people can take some risk off the table and still achieve their goals, or their fair rate of return goal, or their income goals, whatever that might be.
I think another thing that we're going to start to see too is, the last 10 years has been dominated by technology, and there may be just some shift, some new market leadership that starts to emerge. I mean, one of the things that COVID brought to light, Elias, was the things that we did well in America and the things that we didn't. And we started to realize how reliant we are on other countries for certain items. And I'm just going to pick out one, but just the chip space. The fact that we can't get computer chips. What's happened since that? We've had this initiative to onshore chip making, make it so we're less reliant on these other companies. So there may be areas of our market or different market leadership and opportunities that start to emerge because of this. I don't want to call it domestication, but bringing of companies back to America to make sure what happened during COVID doesn't happen again.
And that would be, I would think, a good thing for everyone. I think that would be a good thing. And I think a lot of people probably feeling the pinch the last year that there's certain things we can't get here. I mean, ultimately, with the price of labor here, those items will be more expensive, but it's kind of one of those things where, well, if it's going to be more expensive, we all just have to be okay paying the extra cost, but at least we can have all the products and the services we need without relying on, things that are imported.
Elias, another thing that people should probably start paying attention to, and truth be told, in a zero interest rate environment, when money was easy, monetary policy was easy, people paid less attention to earnings. But I believe that growth investing is going to be very dependent upon earnings. And one of the things that people should be thinking about is, if we do have a deep recession, companies are going to earn less. So you mentioned, I don't remember what you mentioned, that the market is maybe trading at near a fair earnings multiple right now. Historically, the S&P 500 trades around 16, I believe. But if companies lower their earnings and prices stay the same, that inherently raises their price to earnings ratio, right? They're trading at higher. So we could be at 18 or 19. But if they bring their earnings down because of recession, that could bump us to 25. And that could be the next leg down in the market. I don't know as if that's going to happen, but I think with growth companies, you should be very, very, very conscious on what's happening with their earnings. I think of companies that weren't so concerned, Netflix and some of the Netflix, Hulu, the only concern with those companies were what was the subscriber growth. Nobody's worried about how much money they were making because they believed the money would follow subscribers. I think going forward, you're going to have to be watching out for what are these companies' earnings. And once again, it's probably one of the reasons that people are going to lean on dividends. We want to make sure we're getting paid. One of the last things companies do is cut their dividend. That's a negative sign to shareholders if you have to cut your dividend.
Yeah, and to go along with what you're saying, I think investors will be more focused on that, more focused on profitability, but maybe like some of the lesson from this last year is you should always be a little more concerned with that, right? Like even if we are in an environment that dictates you can be a company with very low earnings and get a huge valuation, well, maybe that's okay for some of your money, but you want to probably be careful about that. And really, if you're investing for the long term, being aware and understanding the profitability of the companies you're investing to, it's probably a good thing to always be mindful of.
Well, and it goes back to, we're talking about what we see as trends for next year, but at the end of the day, it goes back to why we believe in well-diversified portfolios that we're utilizing a financial plan to create. Because what hasn't changed over time is diversification. If you had a nicely diversified portfolio this year, you maybe didn't lose as much as the market. If you had some level of exposure to value or dividend-oriented companies, well, those have done better than growth. But if you jumped on the train of, hey, I'm an all-growth investor, you've gotten shellacked this year. I mean,
yes,
and I own growth funds, but I own dividend and value funds too. Well, those have held up relatively well. So I think what hasn't changed through all of this is just a well-diversified portfolio that's been created through a financial plan. And we just want to take people back to what the core principles are, because that's really what makes people successful long term. And we did a show several months ago about, was it the right time to invest? And we said, well, what would your 10-year you say about what you did today? Meaning in 10 years, when you look back, you have a couple decisions. I could sell or I could buy more. There's really two decisions, right? I could do nothing. I could sell. I could buy more. In 10 years, which self is going to be happy? The one that held, bought, or sold? And I don't know the answer to that. But if I look over most 10-year periods of time, the individual who bought or held on would have been very happy, where the one who sold didn't turn out so good.
Yeah, I think we see that in almost every cycle, and there's always examples. There's always examples of people who, like even in 2008, around then, there's plenty of people that got very scared to invest and they didn't want to put their money in the market, and they've missed out on a great bull market since then. But 10 years from now, I would bet that people that bought more and either held their investments or bought more during this current time are going to be happy they did that. And certainly anyone who, younger investors, if there's any younger, and there's plenty of younger investors that do listen to our show, I mean, this is not a bad thing. It's not a bad thing that the market went down and slowed down for a while. You think about new money going in, how long can investors sustain 15%, 20% years in the market? At some point, this is going to happen. And for younger people who are working and saving, it's not a bad thing that the market slowed down for a while. You're getting an opportunity to get in at a lower price, which is a good thing for your long-term wealth building.
What this is all about, Elias, is expectations. And I just pulled up a 5-year return for the S&P 500. And most people's expectations have been I want to make 10 to 15% because that's what the market has done like the last 10 years up until this year. I want to say it was up like 13% a year over the last 10 years going into this year. What do you think the total return for the S&P 500, the price return for the S&P 500 is over the last 5 years?
Total return?
The total,
over
just the total price
5,
return.
2017.
No dividends, just price return.
I don't know, 150?
No, 42.7% for 5 years. That's 9%
Jeez,
a
that
year.
was way off.
Well, think about it, though. It still is 9% a year, Elias. And the market's down 20.
Market's down 20, and we're still up 42% over the last 5 years.
Yeah, if 5 years ago, I would have went to most investors and said, hey, I believe the market is going to be up 42% over the next 5 years. Would you be happy with that? You know what their answer would have been?
Yeah.
Absolutely. But now they're unhappy because they saw their account average, 13% for 5 years. The negative year is all part of the average. It's going to happen. It's just pure math. So don't be upset that the market's down. You're still 42% better off than you were 5 years ago. And there was no place else to go invest that money and make a whole lot of yield. Things are different today because today, there's an opportunity cost to invest. And what I mean by that is you could go buy an investment that pays you a attractive yield or interest rate today. 5 years ago, if I'd have said, hey, you can get 4.5% on a CD, people would have just bought it up left and right.
And now you can.
Now you can, but it's 4.5% and inflation's higher. And I'm not quoting prices, just full disclosure. I'm not, generally I can go find that CD on the open market. You can go to any bank website and find it. But my point is people's expectations are skewed. They expect it to never go down. And I want people to know if you've been invested in the stock market the last 5 years, your stock investments have probably averaged about 9%.
I think psychologically people get anchored to their high account value, right? And that's happened this last year. Everyone's account got, you hit your all-time high value and now your account is down. But I think that's another thing we talk with clients about a lot. The market's never not returned to a previous all-time high. So all-time highs have always been a persisting number, and every time we set one, even if we go down, eventually you set a new one. And I personally don't see why in time that wouldn't happen again. I may be bearish on the market in the short term here, but I'm certainly not. I'm probably very bullish on the market for the long term, and I'm bullish on the economy and businesses in America. So I guess if those are, if you believe we're going to keep making money and companies will keep getting better, it's still probably a good place for your money.
10-year return for the stock market. I pulled it up on Y charts. 188% over 10 years, the last 10 years. Through November 30th of 2022.
That's huge. That's a lot.
188%. So people really shouldn't be upset. And that doesn't even include dividends. That's 18% a year. The last 10 through November. So with that said, I want to thank everybody for listening. We're going to leave it on that note. Let's just have a positive outlook for next year. We don't know what the market holds, but if you just think back and say, hey, if I was in the equity market about 9% the last 5 years, 188% return over 10 years, and this is from Y Charts. I'm on their website right here. To have a positive attitude. Could the market go down? Sure. But if we set the expectations, there's going to be volatility. Let's try to hit our fair rate of return goal. Focus on what we can control. Hopefully 2023 will be a better year for everybody. Do you have any other closing thoughts, Eli?
Yeah, my closing thought. I hope 2023 is a better year. I think ultimately if you focus on doing some planning and good investor behavior, this will pass in time. And I personally have no reason to believe people that stay invested in a diversified portfolio won't be successful over the years. So that's my final thought for today.
With that said, I want to thank everybody for listening. Hope you have a great holiday.